So we begin with the paper of November 2017. Paper of November 2017. So we look at question 3B. Question 3B. Question says that Woodmaster Limited makes quality wooden benches both for indoor and outdoor use. Results have been disappointing in recent years, and a new managing director has been appointed in order to boost the production volumes. After the initial assessment, the director has noted that the budgets have been set at easily achievable levels for employees. He urges that employees would be better motivated by setting budgets that challenge them more in terms of higher expected output other than changing the overall budgeted output. The director has not yet altered the standard cost card. The budgeted output and sales for the month of October 2017 was 4,000 benches. The standard cost card at this output level is provided below. So we have the wood, we have the labor, the variable overheads, fixed overheads, total standard costs, selling price, and standard profit. Overheads are absorbed on the basis of labor hours, and the company uses an absorption costing system. Stocks are valued at standard costs. There were no stocks at the beginning of the month of October 2017. Actual results for the month was follows. Then the average monthly production in sales for some years prior to 2017 had been that 400 units, and budgets had previously been set at this level. Very few operating variances have historically been generated by the standard cost users. The finance director suggested that an absorption costing system is misleading and that marginal costing systems should be considered at some stage in the future to guide decision making. So you are told to get the operating profits and a statement reconciling the actual and the budget profit for Woodmaster. So that is what we're told to do. So the question is on what we call standard costing. It's on what we call standard costing, and specifically profits reconciliation. Profits reconciliation. So we are going to have details here. We're going to have details. Then we will have the formula. Then we will have the workings. Then we'll have the amounts or the value. So with that now, we always begin with budget profit. Budget profit. So budget profit is given as budget revenue minus budget costs. Budget revenue minus budget costs. Now what you can see here is that the standard cost card has given us per unit 280. The profit is 280. And according to the question somewhere, slightly above the standard cost card, we are told the budget is for 4,000 units. So if you take your calc, 280 times 4,000, you will then tell us there is a profit of 1,120,000. It's a profit of 1,120,000. Then from there, you come and bring variances. Variances. Bring the variances. So I told you there is a format that guides you which variances to bring. So the first one is the sales price. Sales price. For the sales price, the formula is budget selling price minus actual selling price. Budget selling price minus actual selling price. You multiply by actual units sold. You multiply by actual units sold. So now, if you look at the budget up there in the standard card, the selling price was budgeted to be 2,200. That is the selling price. Then, when you go to the actual results, the actual statement, huko chini, you can see the sales were 7,200,000. And this was in regard to 3,200 units. 3,200 units. So when you divide that, you will be able to know what was the actual selling price. So can you compute now and give me the answer for that? Compute and send me the answer. waiting for the answer. Yes, Timothy, 160,000, which is favorable. Good. It is favorable because we sold at a higher price. It's favorable, we sold at a higher price. The next one is called sales volume. Now, sales volume is given as budget sales units minus actual sales units. Budget sales units, you minus actual sales units, multiplied by standard contribution margin. Multiplied by standard contribution margin. So we budgeted to sell 4,000, and the actual turned to be that 200. And the standard contribution margin is the selling price. If you get the selling price, you subtract the variable cost. The selling price of 2,200, you subtract material of 800, you subtract labor of 320, and the one of 160. That will give you the standard contribution margin. Alternatively, you could have taken the net profit, you add back the fixed costs. You add back the fixed costs. So do that and give me the answer. The answer is 7,600, which is adverse. Which is adverse because we sold fewer units. The next one is called materials cost. It's called materials cost. So materials cost is given as standard material cost minus actual material costs. Standard material costs, you minus the actual material costs. So how do you get the standards? You go to the standard card and identify that material was 800 shillings. Material was 800 shillings. And then you go to the actual results, information number 3. Information number 3, and somewhere there at the middle, after the fixed overheads, you can see the total production. Total production was 3,600. Total production was 3,600. That is the one that you use. Now you multiply that, rather you less now the actual material cost, which is recorded in information 3 as 2,800,000. As 2,800,000. So this would be 80,000, which is favorable. 80,000, which is favorable. Let's go to labor costs. Let us go to labor costs. Labor cost is given as standard labor costs minus actual labor costs. Standard labor costs minus actual labor costs. Actual labor costs. So ukiangalia hapo juu, you find that per unit it was 320. It was 320. You multiply by the actual units that were produced, 3,600. Then you less the labor of 1,120,000. You less the labor costs. So this is 320 times that is 600 minus 1120,000. And that becomes that 2,000, which is also favorable. That 2,000, which is also favorable. Then we have variable overheads. Now, variable overheads, we have standard variable overheads, actual variable overheads. Standard variable overheads minus actual variable overheads. So in the standard card, it is 160. It is 160 per unit, multiplied by the units that were produced, 3,600. 3,600. Then go to the actual results. The actual results you find, it is 600. It is 600. So when you say 160 times that 600 minus 600,000, you record 24,000, which is advance. 24,000, which is advance. $4,000, which is advance. The next one is the fixed overheads. Fixed overheads. Now, fixed overheads is, first of all, the expenditure. We get the expenditure. For the expenditure, we normally say it is budget fixed overheads minus actual fixed overheads. Budget fixed overheads minus actual fixed overheads. So, how do you get to know the budget fixed overheads? You go to the standard card. You go to the standard card and find that the fixed overhead cost per unit was 640. It was 640. Now this one, it was budgeted for 4,000 units. So you multiply by 4,000. What you get here now is the budget fixed overhead. It's the budget fixed overhead. You minus the actual fixed overheads. The actual fixed overheads were 1,960,000. So you say 640 times 4,000 minus 1960,000. I'm recording some 600,000, which is favorable. 600,000, which is favorable. Then from there, we bring the volume. Now, volume, I told you, you only bring it if there are stocks. You only bring it if there are stocks, which in this case, it happens to be. So it's going to be given us budget output units minus actual output units, budget output units minus actual output units. You multiply by budget fixed overheads per unit. Budget fixed overheads per unit. So according to our budget, we want to have 4,000. And the actual output turned to be that 600. And the per unit is 640. Per unit is 640. That gives us 256. Now this one is supposed to be adverse. It's supposed to be adverse, but for the purposes of reconciliation, it is interpreted in the opposite direction. So we will call it favorable, although if it is just operating variances, you just leave it as adverse. So the next thing now that you bring is the actual profit. The actual profit. So the actual profit, you go to the actual statement and find that it was 1,488,000. It was 1,488,000. And this actual profit, it is the actual revenue minus the actual cost. The actual revenue minus the actual cost. So how do you reconcile? I told you what to do. You get the budget profit. You add the favorable variances. You less the adverse variances. And that will give you the actual profit. So do that, and if it reconciles, you type yes. If no, you type no. Tell me whether it's balancing.
Number 3 is the line of the activity of the partner. Manual productivity of the partner. The manual productivity of the partner increases. The demand for the partner will also increase, and vice versa. The manual productivity of the partner increases. The demand for the partner will also increase, and vice versa. The demand for the partner will also increase.
Yes, Eva agrees. What about the others? Mother is okay. Bev, okay. Monsieur, okay. Yeah, Timothy, you're using 2 gadgets. Remove one. You're appearing twice. So we've gone out to question 4A. Question 4A says, People Limited is planning to launch a new product into the market. In order to determine the introduction of selling prices of the product, the market research was undertaken. The following information has been obtained from the research under two possible selling prices. The variable production cost would be shillings 120 per unit for production volumes up to and including 100,000 units each year. However, if production exceeds 100,000 units each year, the variable production cost per unit would fall to shillings 110 for all units produced. Advertising costs would be 9 million per annum at a selling price of shillings 309.7 million per annum at a selling price of shillings 350. Fixed production cost would be shillings 4.5 million per annum. Now advise the management on the optimal selling price per unit for the new product. So that question is on the question number 4A. Is on what would call multi-stage decision making. Multi-stage decisions making. And in this one, we always begin with coming up with a sketch. If you were to look at how the sketch would appear, it is something like this. We have two prizes, and each of the prizes has 3 demands. Each of the prizes has 3 demands. So those are 6 of them. So we can try to design that. Try to design and the design will be like this. I will have total contribution here. Being equal to or I can even put it in columns. Have units sold unit variable cost selling price so if this one I call it A and this is B and this is C, then this will be A minus B multiplied by C. Multiplied by C. That is where or how I will get my total contribution.
choice of one action therefore means that several parameters can be performed. Choice of one action therefore means several parameters can be performed. So applications of the principles individual parameters. As application of the principles of the individual parameters. Individual parameters. Use the concept of the principles
of the vision tree there.
while designing the combination of property. While designing a combination of product.
So there is a selling price of 350.
For example, produce more of one product.
Or we can start with the one of 300. Then the units are 120, 110, and 140. 120,000. The probabilities are 0.4, 0.5, 0.1. Point 334. When you are through with the drawing, say finish. Maybe I could even put the figures. For the selling prices, this one is 300, 300, 300, 350, 350, and 350. The variable costs, we are told it is 120 if you go up to 100. But beyond that, it is 110. So then this one is 110, 110, 110. This is also 110, but this is 120, and this is 120. Then this one, we can have our figures in thousands for the units, so that we talk of 120, 110, 140, 108, 100, and 94. And therefore, even our contributions will be thousands. Our contribution will be thousands. Then the fixed costs, we are told for advertising is 9,097,000. So here, utaweka 9,000, hapa ni 9,700. Plus, there is a fixed production of 4,500. So inaongezwa hapo na zote zinakuwa in brackets. All of them are in brackets that. So get the contributions huko.
Where we can guess the countries specialize in the production of goods and services. Where we have where studying the market rate of interest. Studying the market rate of interest is the opportunity cost of holding money. Holding that money. Finally, in after regarded as the course of keeping the capital production in its current utilization. Keeping the capital production in its current utilization.
Have we finished? Let's get to the payoffs now. 300 minus 110 equals times 120 is 22,800. 22,800. 300 minus 110 times 110 is 2,900. 300 minus 110 times 140 equals 26,640. 350 minus 110 times 108 is 25,920. 350 minus 120 times 100 is 23,000. 350 minus 120 times 94 is 21,620. So if we are okay with that, the next thing you do, kuja hapa, unatengeneza kitu kama hii. Whereby you have the node and then expected monetary value. Expected monetary value. So for number one, you will say 0.4 times 22,800 plus 0.5 times 2,900 plus 0.1 times 26,640 equals, so 0.4 times 22,800 plus 0.5 times 2,900 plus 0.1 times 26,640 is 22,234. That is the first note. We go to the second one. You say 0.3 times 25,920 plus 0.3 times 23,000 plus 0.4 times 21,620 equals, so 0.3 times 25,920 plus 0.3 times 23,000 plus 0.4 times 21,620 is 23,324. Then number 3. There is something that I forgot. Let's make the adjustments. There is something that I forgot here. We were supposed to subtract these ones. They are coming in there. We are supposed to subtract those ones. That is 9,000 plus 4,500. So here we subtract 13,500. And here 9,700 plus 4,500 is 14,200. So then we should have saved this is 9124. The 734. Yeah, sorry for that mistake. So now when you come to number 3, you just pick the higher. The higher EMV at nodes 1 and 2. And the higher is 9124. So that 9124 imechukuliwa kwa number 2, so utakuja hapa you mark number 2 that way. And based on that, now there are 2 things that you give the advice. The advice is that, as you can see, we have adopted the price of 350. So that means charge a selling price. Charge a selling price of shillings grade 50. Then if they ask you to tell them value of information, it is the difference between these two. So it is 9124 minus 8734. That is how you get the difference. So ukiulizwa how much they would be willing to pay for the value of information, that is how you compute it. Okay. So if you are already there, type the word okay so that I can proceed to the next question. Type the word okay so that I'm able to proceed. Yeah, Beth is okay. It's not always like a different variable under control of the government.
always at the limited time and the program. Sometimes it is completely divided.
Yeah, even Eva is okay. So Wabushi and Timothy. Okay, so let's proceed to read part B. Read part B on your own. I create the whiteboard. You read part B on your own.
Number 4 is that price increases do not affect all groups equally. Price increases do not affect equally.
Oh, we solved part B. Good. Thank you. So we are supposed to go to question 5. Thank you so much. So read question 5B. Question 5B. Read question 5B on your own. Question 5B. And after you read, identify the 5 things that we said should be there. Identify the 5 things that we say should be there. Then you draw this table. When you finish drawing, you write drawn or finished. When you're through, you write finish. Is Eva, that's Ame, that's Timothy. Good. So now you can see we are told the current order point is 850. And I told you, you should always begin at the current reorder point. So we are going to begin at 850. When you begin at 850, the safety stock is 0. And therefore, there is no holding cost. But as you can see, demand can be 900. If it becomes 900, you will have a shortage of 50 units. You will have a shortage of 50 units, and the probability of that happening is 0.05. Plus, if demand becomes 950, you will have a shortage of 100, and the probability of that happening is 0.04. Plus, demand can be 1,000, where you have a shortage of 150, and the probability is 0.03. Plus, demand can be 1050, so you record a shortage of 200. And the probability is 0.03. Plus, demand can turn to be 1100, where you have a shortage of 250 with a probability of 0.02. Now this one, you multiply by, you multiply by the annual number of orders, which we are informed so well that they are 5, that is the number of orders. And then the shortage cost per unit, we are told it is 5,000 shillings. 5,000 shillings. So multiply out and give me the answer. Multiply out and send the answer to me. Multiply and send the answer. That is 50 times 0.05 plus 100 times 0.04 plus 150 times 0.03 plus 200 times 0.03 plus 250 times 0.02 equals times 5 times 5,000. I'm getting 550,000. Now that 550,000, you bring it here. 550,000. 550,000. You try now the next one, which is 900. 900 has a safety of 50 units. So the holding cost will be 50 times. If you look at information 3, information 3, the holding cost is 1,000. So that gives us 50,000. That gives us 50,000. Then, if you have 900 and demand turns to be 950, you record a shortage of 50 units with a probability of 0.04. Plus, if it goes to 1,000, you record a shortage of 100 with a probability of 0.3. If it goes to 1050, you record a shortage of 150 with a probability of 0.03. If it goes to 1100, you report a shortage of 200 with a probability of 0.02. Now this one you multiply by 5, and then you multiply by 5,000. So get your answer on that. So the answer you should have 50 times 0.04 plus 100 times 0.03 plus 150 times 0.03 plus 200 times 0.02 plus 5 times 5,000. It's something I've missed. 50 times 0.04 plus 100 times 0.03 plus 150 times 0.03 plus 200 times 0.02 equals multiplied by 5 multiplied by 5,000. 337,500. 337,500. So here, ongezea please 50,000. You will get 387,500. 387,500. Now you try 950. 950, you have a safety of 100. So 100 times 1,000 will be 100,000. Will be 100,000. So you can only be out of stock if you go beyond this at 1,000, which will be a shortage of 50 units with a probability of 0.03. Last, the next one is 100 with a probability of 0.03. The next point you'll be out of stock is at 150 units, and that has a probability of 0.02. Now that one you multiply by 5, you multiply by 5,000. You multiply by 5,000. So if I say 50 times 0.03 plus 100 times 0.03 plus 150 times 0.02 multiplied by 5 multiplied by 5,000. I bought 187,500. So you add the 100, you get 287,500. 287,500. Then we come to 1,000 units. At 1,000 units, you have a safety of 150. You have a safety of 150. So you can only be out of stock if demand turns to be, rather before I talk of that, I need to say 150 times 1,000. And that is 150,000. 150,000. So you can only be out of stock if you go to 1050. That will be 50 units at 0.03. Or if you go to this one of 1100, and that will be 100 units with a probability of 0.02, then multiplied by 5, multiplied by 5,000. So that will be 50 times 0.03 plus 100 times 0.02. Multiplied by 5, multiplied by 5,000. It is 87,500 plus 150,000 is 237,500. Then here you have a shortage, a safety of 200. So it will be 200 times 1,000. That is 200,000. So you can only be out of stock if you go to 1100. That will be 50 units with a probability of 0.02. With a probability of 0.02. Multiplied by 5, multiplied by 5,000. Multiplied by 5,000. So that will be 50 times 0.02 times 5 times 5,000. So that is giving me 25,000. So when I add this one, I get 225,000. 225,000. Then finally, this is 250. So 250 times 100. That gives us 250,000. So here you cannot have a shortage. So the total here is 250,000. 250,000. And now the question was asking us to advise on the safety stock to be maintained. So I told you, you come here and pick the smallest. We are going to pick that one. It's the smallest. So the advice that we shall give is that optimal safety stock. Optimal safety stock is 200 units. And the other one, probability of stock out. Probability of stock out is 0.02. That is, once you take this one, you can have a demand of this one, which will create a shortage. And the probability of 1100 is 0.02. 0.02. So that is how you are supposed to address it. If you are okay, you can type yes. If you are not, you can raise your concern. Mother is okay. Okay, so I think we'll have to stop there because I can see we have around 5 minutes. Those ones may not be enough to start and finish the question. So we stop there, then we meet God willing on Saturday, which will be our last lesson to attempt May 2017. So thank you so much.